We're halfway through 2024 and Vanguard just released its mid-year market outlook. Today I'm going to go through that outlook and give you two brief takeaways that you can use as long-term investors to help you make better financial decisions. Okay, so let's get to the chart. So what we've got here is looking at all these different equity asset classes from US, then you have global, and then it goes down and down all the way to US REITs or real estate. And if you look at the different color codes, what we've got is this light green bar on the top, or this light teal bar at the top, is 2023, what were the year-end market outlook numbers, and then what were the 2024, so where are we today? So we've had about 6 months, and as you can see, these numbers haven't really changed much. So the bar at the top is pretty close to the bar at the bottom in pretty much every asset class. Now the first takeaway that I want you to think about when you look at this chart is why hasn't it really changed much? Well, the reason is, what this is, these are using capital market assumptions, and this is a 10-year expectation for returns. And so what's the difference between something like this, which is a 10-year expectation for annual returns, and when people kind of give you their mid-year market expectation for the end of the year? Well, as we've discussed in prior videos, pretty much no one can predict or determine where the market's going to be over a short time period because it's highly dependent on what people think on any given day. And so markets can go up based on if things are expensive or cheap, they can go down. It's impossible to predict. But what happens is, as we look over longer periods of time, in this case over a 10-year period, the price that you pay for investments and cash flows really matters, and you can get pretty accurate within a pretty tight range when you're looking and saying, based on the current fundamentals and the price of those fundamentals, what are the expected long-term rates of return, in this case 10 years, for different asset classes. And so the first takeaway is the reason that from the beginning of the year to the middle of the year, it hasn't really moved much, is because 10-year expectations don't move around like these 1-year or 6-month essentially market calls you might hear on the news, which are, again, largely guesses. These are not necessarily guesses, these are just the math behind what are the fundamentals and then what are the prices people are currently paying for the fundamentals. And so that's how you can get these 10-year numbers that are relatively accurate. Okay, now what's another piece? So the first one is not much changes over a 6-month time period. And the other is keeping in mind this is a 10-year average rate of return for each of these different asset classes. What do we notice? Well, if you go at the top and you go all the way to the bottom, what you'll see is the kind of the bars that go furthest to the right that have the highest expected annual rate of return is global stocks. So non-US companies. Now, why is that? Well, it's because currently non-US companies are much less expensive given their current dividends and earnings than US companies. So the expected rate of returns are higher. So if you pay a lower price for earnings and dividends, your expected rate of return goes higher. If you pay a higher price for cash flows, your expected rate of return goes down. And so international markets are cheaper, which means they have a much higher expected rate of return. And what's the other side of that? As we go down, we can look at, okay, US equities. What about US large cap growth? So US growth is all the way on the left of everything across the world with an expected rate of return as of the middle of this year, anywhere between 0.4 and 2.4%. Now this is an expected annual rate of return. So basically between 0 and 2.5% is the expected rate of return for US growth. Now why is that? Does it mean, do we not think these companies are going to do well? Do we not think the US is going to do well? None of that's the case. The US might do great. These companies might have continued earnings and dividend growth, but the challenge becomes the price that people have currently paid for those dividends and earnings have gotten incredibly high. And so again, price goes up, future expected rate of return, all else being equal, goes down. And so prices have come up to the point where there's essentially not much room to run in US growth. And this is according to Vanguard's 10-year market outlook. And this is pretty consistent if you look across other firms' capital market assumptions. International markets are relatively inexpensive. The US markets, in particular growth, are very expensive. Now, none of this is any version of a guarantee. No one knows what's going to happen in the future. That's why they call it the future. But what it does mean is that you should take a close look at your own portfolio and your own plan and talk to your advisor and say, okay, knowing this, how does our portfolio look, and are we comfortable with the expected rate of returns and with the risk that we're taking? I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.